Consumption is the largest component of GDP in the USA, and half of that consumer spending is now done by just 10% of households. If they pay significantly less taxes, they're going to have more money to spend, driving up inflation in very narrow markets. Now, beyond the immediate social issues of already high income earners getting tax breaks at the expense of 90% of the population, there are pragmatic economic problems as well. Lots of people spending money requires lots of employed people to process those sales, and if only a small share of the population is spending most of the money, then naturally fewer will need to be employed to serve those consumers. Again, this isn't new by itself. We actually made a video on the K-shaped recovery where wealthy people will do really well and everybody else will do really badly, and the problems that could cause, over 5 years ago now. The problem is that instead of managing those risks, current fiscal policy is just turbocharging them. This puts the Fed between a rock and a hard place even more than they would be when facing stagflation, because different policies are going to have different impacts on different parts of the wealth spectrum, and the further they drift apart, the harder those differences are going to be to manage. For wealthy people and high income earners, the biggest impact that lower interest rates will have is increased asset prices. There are two general mechanisms that make this happen. If interest rates are lower, it's easier to borrow money to invest and simultaneously more rewarding. Imagine a company that makes a profit of $10 million per year, but is worth $100 million. Assuming no capital gains, that's a return on investment of 10%, which is pretty decent. If interest rates were 5%, an investor could get returns twice as high by making a riskier investment into this company compared to just keeping their money in a savings account paying the nominal interest rate. If, however, interest rates dropped to 2.5%, but the company was still making $10 million per year, it could be worth $200 million while still providing twice the rate of return of a secured savings account. Now, this is, of course, an incredibly oversimplified example, but it's how these investment decisions are made. Nobody is going to invest into a risky business when they could get better returns in risk-free savings or bonds, and the lower the interest return is, the more people are willing to invest in other forms of income. Increasing asset prices primarily help wealthy people who own most of the assets and gives them more money to spend, which, as we have already seen, is not a problem since they are doing half of the spending in the economy already. For less wealthy households that don't have a stockpile of investable assets, rising prices can make it harder for them to catch up, especially in areas like housing. The lower interest rates will help them a little bit, but consumer debt tends to be overall less sensitive to baseline interest rate changes anyway. A margin loan or a mortgage going from 5% to 2.5% halves the interest expense. A credit card going from 22.5% to 20% might help a little bit, but not to the same degree. And again, this isn't just a moral problem. Crushing the majority for the benefit of asset owners can lower productivity. That company from earlier that jumped from $100 million to $200 million may have been great for existing investors, but it was still producing the same total output. So, higher prices and lower employment, that is stagflation. And there's a good chance that the US is already there, but changes in the nature of the economy mean that they just haven't realised it yet.